Do you want to avoid making costly investing mistakes in 2023? Welcome, dear viewers, to our exploration of the financial world, where we'll delve into the art and science of making smart investing decisions. In the upcoming year, as the global financial landscape continues to shift and evolve, it's more important than ever to stay ahead of the curve. As we journey together, we'll highlight 5 common investing missteps that could potentially derail your financial goals. These pitfalls are often overlooked, yet they can be a significant factor in the success or failure of your investment strategy. From the absence of a clear investment plan to the temptation of chasing trends, from the pitfalls of overdiversification to the hidden costs and fees, and finally, the danger of emotional investing, we'll tackle them all. So, are you ready to safeguard your hard-earned money and secure your financial future? Stay tuned as we journey through the key investing mistakes to be avoided in the upcoming year. The first mistake is not having a clear investment plan. Picture yourself on a journey. You wouldn't set out without a destination in mind, would you? Similarly, investing without a clear plan is like embarking on a journey without a map. You see, in the world of investing, a clear plan serves as your compass. It helps you navigate the often turbulent landscape of financial markets and keeps you focused on your ultimate financial goals. Without it, you're simply treading water. Or worse, you could be heading in the wrong direction. So, why do many investors skip this crucial step? Some may find it intimidating, while others might be under the erroneous impression that investing is simply about picking the right stocks or timing the market perfectly. But the reality is far from it. Investing is a long-term game, and it requires a strategic approach. Creating a simple investment plan doesn't have to be complicated. It starts with understanding your financial goals. Are you saving for retirement? Do you want to buy a house in 10 years, or perhaps you're planning for your child's education? Once you've identified your goals, it's all about aligning your investments to achieve them. Next, consider your risk tolerance. How much risk are you comfortable with? If the thought of losing money keeps you up at night, you might want to lean towards more conservative investments. On the other hand, if you're okay with some ups and downs in the pursuit of higher returns, you might be more suited for riskier assets. Then, it's about diversification. Don't put all your eggs in one basket. Spread your investments across different asset classes like stocks, bonds, real estate, and more. This can help mitigate risk and potentially increase your chances of achieving your financial goals. Lastly, remember to review and adjust your plan periodically. As your life circumstances change, so should your investment plan. Remember, without a plan, you plan to fail. Don't let your hard-earned money drift aimlessly in the financial ocean. Set a course, stick to it, and you'll be well on your way to achieving your financial dreams. The second mistake is chasing trends. It's a common trap that many investors fall into, the allure of the latest hot stock or the promise of a quick return. But trend chasing can be a risky game, akin to trying to catch a falling knife. You see, by the time a trend becomes apparent to the general public, savvy investors have often already capitalized on it, leaving latecomers to bear the brunt of any downturns. Trends can be tantalizing, especially when you see others seemingly making a fortune overnight. But remember, for every investor who strikes gold, there are many more who don't. And the harsh reality is, most people who try to time the market or jump on the latest trend end up losing money. Why does this happen? Well, trends are often driven by hype and speculation, rather than solid financial fundamentals. And when the hype dies down, so does the stock's price. This can lead to significant losses for those who bought in at the peak of the hype. Instead of chasing trends, a better strategy is to focus on thorough research and long-term investing. Look for companies with strong fundamentals, such as steady earnings growth, manageable debt, and a competitive advantage in their industry. These are the kinds of investments that can provide steady returns over the long term, rather than a quick buck that may evaporate as quickly as it appeared. But don't just take my word for it. The world's most successful investors, from Warren Buffett to Peter Lynch, have all emphasized the importance of investing for the long term and ignoring short-term trends. They know that successful investing is a marathon, not a sprint. So next time you're tempted to jump on the latest trend, take a step back. Ask yourself, is this a solid investment or am I simply chasing the crowd? Remember, the goal of investing is not to get rich quick, but to build wealth over time. Avoid the herd mentality and stay focused on your investment goals. A wise investor knows that patience and discipline are far more valuable than the fleeting thrill of chasing trends. The third mistake is over-diversification. It's a phrase that might seem contradictory at first. Diversification, after all, is a cornerstone of smart investing. It's the practice of spreading your investments around to reduce the risk associated with putting all your eggs in one basket. It's a safety net, a way to hedge your bets in the unpredictable world of investing, but like most things in life, it's possible to have too much of a good thing. Over-diversification occurs when an investor spreads their investments too thin. Instead of having a well-balanced portfolio, they end up with a smorgasbord of investments that can be difficult to manage effectively. And while it may seem like this approach would further reduce risk, it can actually do the opposite. Why? Because with too many investments, it's hard to keep track of everything. You may not be able to adequately research and understand each investment. You may miss out on important news or developments that could impact your portfolio. And you may find it harder to make timely decisions. Moreover, over-diversification can dilute your returns. If you've invested in so many assets that your portfolio essentially mirrors the market, then your returns will likely be average, at best. You may miss out on the opportunity to outperform the market with a more carefully selected, focused portfolio. So, how can you avoid over-diversification? The key is balance. You want a diverse portfolio, but not so diverse that it becomes unmanageable. A good rule of thumb is to invest in a variety of asset classes, such as stocks, bonds, and real estate, and within those classes, to choose a manageable number of high-quality investments. Remember, the goal of diversification is not to own a piece of everything, but to reduce risk and increase potential returns. So, be selective, do your research, understand what you're investing in and why. Diversification is your friend, but like all good things, it should be done in moderation. Making wise decisions about diversification can help you avoid common investing pitfalls and set you on the path to financial success. The fourth mistake is ignoring fees and costs. Let's talk about the silent killers of investment returns. Fees and costs. These are often overlooked, with investors focusing solely on the potential gains. But remember, investing is not just about what you make, it's about what you keep. Consider this. Even a seemingly small fee of 1% can eat into your returns significantly over time. For example, if you invest $1,000 and earn a 10% return, but pay 1% in fees, your net return drops to 9%. Doesn't seem like much, right? But over the course of 20 or 30 years, that 1% fee can reduce your total return by a staggering amount. Fees come in many forms, like transaction fees, management fees, and even taxes. It's crucial to understand these costs and how they impact your overall returns. And while some costs are unavoidable, others can be minimized. For instance, choosing low-cost index funds over more expensive mutual funds can save you a lot in fees. Or consider using a tax-efficient investment strategy to reduce your tax burden. The bottom line is, don't ignore fees and costs. Be aware of them, understand them, and where possible, minimize them. Remember, every penny counts when it comes to investing. The final mistake is emotional investing. A common pitfall that even the most seasoned investors sometimes stumble into. Emotional investing is when we allow our feelings to guide our decisions rather than logical and strategic thinking. It's when we buy high out of greed, thinking that a soaring stock will only go higher, or sell low out of fear, convinced that a plummeting stock will sink even further. But the stock market is like a roller coaster. It has its ups and downs, but over time it generally trends upwards. Allowing emotions to dictate your moves can make this ride even more turbulent, potentially leading to regrettable decisions. So how do you keep your cool amidst market volatility? The first step is to be aware of your emotions. Acknowledge that it's natural to feel fear or greed, but remember that acting on these emotions can be detrimental to your investment portfolio. Second, always refer back to your investment plan. This should be your compass during turbulent times, guiding you towards your long-term financial goals. Third, maintain a diversified portfolio. This can help cushion the impact of market volatility and reduce the likelihood of panic selling or irrational buying. And lastly, consider seeking the advice of a financial advisor. They can provide an objective perspective, free from emotional bias, helping you make sound decisions based on facts and analysis. In the world of investing, emotion is the enemy of logic. Keep emotions out of investing to make sound decisions. In conclusion, successful investing requires careful planning, disciplined strategy, and emotional control. It's a delicate dance, one that requires us to be fully in tune with our decisions and the potential repercussions. We've navigated through 5 common pitfalls that can derail even the most seasoned investors. The lack of a clear investment plan, chasing the latest trends, over-diversification, disregarding fees and costs, and finally, emotional investing. Each of these, if left unchecked, can profoundly impact your investment journey. We must remember to plan with precision, be disciplined in our approach, and not let our emotions cloud our judgment. Investing is not a game of chance, but a calculated venture. A venture that, when navigated with caution, can lead to impressive returns. Let's strive to avoid these mistakes as we traverse the ever-changing landscape of investing. Remember, investing is a marathon, not a sprint. Here's to a successful investing year in 2023.